Last month, for the first time since Alphabet went public in 2004, 22 years of being a public company, Google's parent reported negative free cash flow. Not a slowdown, not a compression, negative. They spent $44.9 billion on AI infrastructure in a single quarter, generated $39.1 billion in operating cash flow. The result? Negative $5.9 billion, the first cash burn quarter Google has reported since its IPO. And Amazon? Its trailing 12-month free cash flow fell 95% in 1 year, from $25.9 billion down to just $1.2 billion, as it races to deploy $200 billion in AI capital expenditures in 2026 alone. Its full-year free cash flow is now projected to go negative as well. Here's why that matters to you directly. If you're holding the S&P 500 or the QQQ right now, Alphabet and Amazon are 2 of your 5 largest positions. The companies absorbing nearly half of your index weight are burning cash at a scale that would have been unthinkable 5 years ago. There's an ETF that has been quietly screening against exactly this kind of company for 3 years, and in 2026, it's outperforming the S&P 500 by nearly 8 percentage points, while absorbing a fraction of the drawdown during every major sell-off. I want to show you exactly how it works, and whether it deserves a place in your portfolio. The problem your index isn't telling you. Here's something most S&P 500 investors don't fully absorb. The top 10 stocks in the index now account for over 40% of its total weight. Some current estimates put it at 43%. To put that in context, at the peak of the dot-com bubble in 2000, the top 10 only represented roughly 27% of the index. We've blown well past that, and it's still climbing. So when you buy an S&P 500 fund and tell yourself you're diversified across 500 companies, you're technically correct. But nearly half of every dollar you put in is riding on Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, and a few others. The QQQ is even more concentrated, same names, heavier weighting. Now, that's been fine in environments where those companies are growing their cash flows, but we're entering a different environment, one where the same companies dominating your index are the ones spending the most aggressively on AI infrastructure, watching their free cash flow compress or disappear entirely. And here's the part that doesn't get said enough. A market cap weighted index is structurally forced to hold more of those companies as they get bigger, regardless of what's happening to their financials underneath. That's the quiet risk most passive investors aren't pricing in. Let's define free cash flow cleanly, because this is really the whole story. Free cash flow is the money left over after a company has paid for all its operations and all its capital expenditures. It's what a business can actually do something meaningful with: fund dividends, reduce debt, buy back stock, or reinvest in genuine growth. Companies with strong and growing free cash flow tend to be more resilient in downturns, more self-sufficient, and historically more rewarding to own over long periods. Companies with collapsing or negative free cash flow become increasingly dependent on borrowing and equity issuance to fund their ambitions. That's exactly the dynamic playing out right now. Pivotal Research projects that Alphabet's full-year 2026 free cash flow could fall nearly 90% from 2025 levels. Amazon is expected to turn negative. The 4 major hyperscalers, Alphabet, Amazon, Meta, and Microsoft, are collectively projecting to spend nearly $725 billion in capital expenditures this year. That's up 77% from 2025, which was already a record. This isn't a bearish argument against AI. AI infrastructure spending could absolutely generate enormous returns over the next decade. But right now, in 2026, the companies absorbing the most capital expenditures are the same ones anchoring your passive index fund. If you want a portfolio with genuine cash flow discipline, you have to build outside the standard indexes. Introducing VFlow, the VictoryShares Free Cash Flow ETF, ticker VFLO, launched in June of 2023, right as the AI capital expenditure cycle was beginning to accelerate. When it first appeared on the radar about 2 years ago, it had a few $100 million in assets. Today, it holds over $7.5 billion, making it one of the fastest-growing ETFs in its category. That growth matters. It reflects real institutional capital moving into this strategy, not just retail speculation. When institutional money migrates toward a specific ETF methodology, it tends to signal genuine conviction in the underlying framework. Expense ratio, 0.39% net. That's higher than a bare-bones S&P 500 index fund, but still reasonable for the quality of screening involved, and well below most actively managed alternatives. And as you'll see, the consistent outperformance has made that cost worth paying. How VFLO actually works. VFLO uses a 3-step screening process, and each step is deliberate. Step 1. It starts with the 400 most profitable large-cap US companies, with a specific emphasis on free cash flow yield. Free cash flow yield is the ratio of a company's free cash flow to its enterprise value, the true size of the business, which includes its debt, not just its market cap. It tells you how much real cash a business generates for what you're actually paying. Step 2. That pool is narrowed to the 75 highest free cash flow yielding value stocks. And this is where VFLO separates itself from every other free cash flow ETF on the market. Most competing funds, most notably cows, analyze only trailing free cash flow, the past 12 months. That means they're reacting to trends that are already reflected in prices. VFLO looks at both trailing and expected free cash flow, analyzing where cash flow is headed, not just where it's been. The results of that difference are striking. Over the past 3 years, VFLO has returned roughly 23.9% annualized compared to Cow's 11.6%. That's more than double. Year to date in 2026, VFLO is up about 21.9% versus Cow's 8.4%. The gap is widening, not narrowing. When you look at the data, the logic becomes clear. Forward-looking cash flow analysis lets you capture momentum before it's priced in. Trailing-only analysis keeps you permanently one step behind. Step 3. A growth filter. This eliminates slow growth companies and pushes the portfolio's projected growth rate to approximately 11%. The result is a concentrated portfolio of roughly 50 large-cap US companies, businesses that are generating high current free cash flow, expected to generate even more going forward, and growing at a meaningful rate. Quality screened rather than market cap weighted. It's the opposite of what a passive index forces you to own. The performance. Since VFLO's June 2023 inception through mid-2026, it has returned approximately 93% on a cumulative total return basis, compared to roughly 78% for the S&P 500. That's about 15 percentage points of cumulative outperformance, with a higher Sharpe ratio of 1.17 versus the S&P 500's 1.06. Better risk-adjusted performance, not just higher returns. Year to date in 2026, VFLO has returned approximately 17.8% compared to the S&P 500's roughly 10%. But the number that I think tells the most important part of the story is the downside behavior. During the April 2025 market sell-off, VFLO fell approximately 8% compared to the S&P 500's 13%. During the early 2026 volatility, driven heavily by AI capital expenditure announcements from Amazon and Alphabet spooking markets, VFLO's peak drawdown was roughly 1.8% against the S&P 500's approximately 7%. Think about what that asymmetry means over time. Less damage on the way down, more participation on the way up. That combination is rare, and it's not accidental. It's the direct result of owning companies that generate real cash rather than spending it. One important note, VFLO carries a dividend yield of around 1.2%, which means this isn't an income play. Don't confuse it with a dividend ETF. It's a growth strategy anchored in quality discipline. That said, its historical dividend growth rate has run approximately 15% annually, which compounds into something meaningful for investors with a long time horizon. The real trade-off. The only genuine drawback with VFLO is also the most obvious one. 50 holdings is a concentrated portfolio, more concentrated than 500. That means slightly more day-to-day price volatility, and yes, you can see that in its historical price chart. No investing strategy works in every environment. If AI infrastructure spending generates enormous returns in 2027 and 2028, and the mega-cap tech companies recover their free cash flow profiles, VFLO could temporarily lag a broader index. Factors go in and out of favor. 3 years of live performance, while genuinely impressive, isn't a full market cycle. Historically, the outperformance is significant, but investing with humility means acknowledging that no strategy is perfect, and anyone telling you otherwise is selling something. You don't need to replace your S&P 500 entirely, but if you're currently pairing the S&P 500 with the QQQ as your version of diversification, there's something worth understanding. You're not actually diversified. You're holding two indexes with heavy overlap in the same concentrated group of tech companies, where one simply falls faster than the other when the market rotates. Pairing VFLO with the QQQ is a structure